Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your EduTrainer National Insurance columnist, Steve Savant.
Hello everyone, Steve Savant, your EduTrainer and coach for the entry-level life insurance workshops. We're doing all this week the essentials, and today I'm talking about withdrawals, policy loans, and annuitization on life insurance. But before we get into it, I want to say we're brought to you by Lincoln Benefit Life, an Allstate company, and we're using Lincoln Benefit Life's great software, the Eclipse software, that is, we voted as the #1 most user-friendly software in our industry. It's really helpful for learning. We want you to go out to their site, www.lblsales.com/ETW. When you come out to this site, you'll see the Run Installer. It'll come right to the home page, and you'll click on it, and when you go ahead and download it, then you'll be able to go page by page with us. And about next week or so, we're going to be getting into it, and we're going to be using their software. So we want you to get into their software before we get there so you can go page by page with us. We think it helps your learning experience a lot. Again, www.lblsales.com/ETW. And remember, we're giving away our patented life insurance manual with full vocabulary. You want to always print your vocabulary out when you're listening to our show and say, I know Steve mentioned this. Let's go to the vocabulary and let's check out what he's talking about. It's an excellent tool, and a lot of our agents will print it out. If you're coming into our business for the first time, this is a great entry-level course, and I really like the ability to look at the manual. You have your vocabulary there, and you can always go back online and check out our videos and go refresh yourself. If you want any of the things you see, just write me for the manual, thebiz@brokersalliance.com. That's thebiz@brokersalliance.com, THEBIZ at brokersalliance.com. Well, today we're talking about withdrawals, and we're talking about policy loans. We're going to leave that open. Talk about withdrawals. Now, when I talk about withdrawals, I'm talking about withdrawing money from my contract. I can either withdraw money or I can policy loan money. When I'm usually withdrawing, I want to be withdrawing basis or my original contributions, or insurance language, I want to do my original premiums. And if I want to use withdrawals to basis or my original contributions or premium, I want to be able to know when can I withdraw to basis without any fear of causing a tax. And generally when we withdraw to basis, it's not a problem. But there's an issue called the Forceout Rule. And I could give you the Technical Corrections Act code for this, but I don't want to drown you on an entry-level course. The Forceout Rule basically manages the first 15 years of a policy. So during this first 15 years, if I have gain in the policy, and if you design your contract like I do for supplemental income, that means you suppressed or dropped the death benefit all the way down to either the guideline annual or the guideline single test or the CVAT test. We're going to get into that Friday a little bit. When you look at this, you want to make sure that if I was actually withdrawing to basis, most of the time, so that I don't trigger a Forceout Rule, which could happen, and remember, every carrier is different, I always want to take withdrawals if I have gain in the contract after the 15th year. So it's critical to make sure, because remember, one of the advantages of supplemental retirement income or just getting to cash values is our ability to withdraw to basis free and to take policy loans out so that we can fund whatever our needs are. I know many of us are doing retirement planning using supplemental income of life insurance, and it's an excellent tool. So I definitely want to do this. I just want to remember, when can I do it? So what is my withdrawals? I do it with basis. What is basis? My original contributions or my original premium. And when can I take out my withdrawals? If I have gain in the contract, I don't want to take it out during the first 15 years. So what do I need to do if I want to take money out? Well, if I want to take money out before the 15th year, I'm going to do something called policy loans. And I want to get you to two possibilities, two macro places to think. Policy loans are predicated on, is it current company practice or is it contractual guarantee? Is it current company practice or is it contractual guarantee? It makes a difference. When you're talking about contractual, this is the imperatives inside the policy. And I want to know whatever loan rate they're showing me, especially on illustrations and proposals, am I really predicating my loans off current company practice, which could change, or am I doing it off contractual guarantees, which are imperatives that are written in the contract? I really like this, and just a little side note for our sponsor, Lincoln Benefit. It's one of the few companies in the United States that allows you to have zero net cost loans, and it's contractually guaranteed. Other companies have zero net cost loans, but it's current company practice. Could they actually elevate or charge you more according to the contract? Well, yes, because that's just current company practice. They could go up to the maximum they could charge. Lincoln Benefit's one of the few carriers that manage that issue, and I think it's a great idea to think about. So, policy loans, the first thing I want to know on policy loans is it current company practice? Is that what the rate is? Or what's my charge? And what's the contractual guarantees? What is that number? And hopefully, like in LBL's case, and they're an oddball in this regard, their current company practice is their guarantee. So that's the first thing I look at. The second thing I look at policy loans is actually some of the loan provisions themselves. The first one I just mentioned to is zero net cost loans. Zero net cost loans is the charging and the crediting of the same rate in a very small time and space. Some carriers are down to 31 days between the time they charge and credit the interest. Some of them go 60 days. But generally, zero net cost loans are the charging and crediting of the same rate. So if I charged 2% and I credited 2%, and I did it within a very small window. In my example, I'm using 31 days. That's a zero net cost loan. I want to know, is it current company practice to do that, or is it contractually guaranteed? The second one is a wash loan. A wash loan is the charging and crediting of the same rate, but it's 365 days apart. A wash loan that's charging and crediting on both sides may have a small accrual charge because of the differentiation between when it's credited and when it's charged. So I just want to always be heads up. My in-force ledgers, I have to ask for this. If you're showing policy loans, I need to see, if you're using wash loans, are you showing me not only the spread, the charging and crediting at the same rate, 365 days apart, but is there any accrual charge between the time it's credited and the time it's charged? Just, it's a heads up, it's a small point, but I want to know that so I can see my all-in costs. The third loan provision is spread loans. Spread loans are the charging and crediting of the same rate 365 days apart. Generally, remember this is a general course. And that's a different spread between two different rates. I'm charging 8%, I'm crediting 6%. There's a spread there. That means my net loan is 2% plus the accrual charge. So in a spread loan, it's this charging and crediting of a different rate, spread, whatever that spread is, 8%, 6%, and my accrual charge. So if my spread loan says the spread is 200 basis points between 8 and 6%, and it's 200 basis points, I might say, well, actually, when I throw the accrual charge in, it might be 225 to 235 basis points because of the time differential, especially if you're loaning from like age 65 all the way out to age 100. Another one is called arbitrage loans, And actually, it's interesting. Arbitrage loans are generally used only in indexing. Now, some people use the phrase participating loans. The reason I don't like that language is because whole life has had that forever. And if I talk about participating loans, it's not the same language. Now, again, different companies have different semantics, and their legal and compliance are all different on this. So you have to be aware that if you're going to talk about this in writing, you'll need to go to your compliance officer and get their approval. Or in my case, I always like to just go and find out, what do you have in print now, and I'll just use that. Arbitrage loans. So you could be actually the index, which is exclusively, well, I don't want to say exclusively, but mostly IUL, Index Universal Life. If I'm using arbitrage loans, I might be pulling down 8% from my index. And I might have a 5% contractual guarantee on the loan. That means not only am I taking my income out, but I actually made 3% or 300 basis points to loan my own money to myself, because the actual index at 8% outperformed the 5% loan provision in the contract. Hopefully it's in the contract, not just current company practice. And remember, some people use fixed rates and some people use variable rates tied to the Moody's or whatever, and that can fluctuate. And if you need to bring solace to your client and continuity, you may want to look at fixed rates just so that you don't have to hassle it. Rates are low now, but remember, I went through the 80s and I remember double digits, so just a heads up. So what happens though if I make 4% only on the index and I'm taking money out at 5%? Well, then it's costing me 1% or 100 basis points to take that money out. And a little reminder, in 2001, in 2002, 2003, and 2008, those were 4 down years in the last decade, all the way through 2011. When you look at those 4 bad boy years and you were trying to take money out, you didn't get anything credited. Think about this. You actually got credited nothing. You still had to pay a 5% loan, and that means that you're paying 500 basis points for the loan provision, and you still had policy expenses to go with it. The policy fee, the cost of insurance, admin charges, and those could be another 250 basis points. It might cost you 7.5% to take your money out of your own contract. So just be careful what you're getting yourself into. Some people love arbitrage loans, are great during times of a bull market, but they can be bad. I just gave you 4 out of the last 10 years have been loser years where, yes, we didn't get anything credited, but during distribution, I still have to pay for that loan charge. So it's very important to make sure we know our policy loan provisions, because they're very, very important. And as I said in the class yesterday, remember, on 1035 exchanges, if you've already executed, the clients are already taking policy loans, they have to come with us to the new loan. One of the things I like about is you might be able to actually better the client's loan provision on monies they've already taken constructive receipt on via policy loans. A last thing I want to bring up, and we don't do this too often, but you could annuitize. You could annuitize your policy. Now, you're not going to get any of the provisions except for your basis back. It's all going to be taxable on the gain. But if you were going to annuitize and you wanted lifetime income that you couldn't outlive, and you wanted to annuitize it for life, you might want to look at, is it better to annuitize or to take withdrawals to basis and 0 net cost loans? Is it better to do maybe the arbitrage loans? There's so many ways to look at this. We hardly ever do this because we like tax-free, the withdrawals to basis and policy loans to gain in the appropriate years. But sometimes some people think, hey, based on longevity and based on the account value, and I might be in a very lower tax bracket, so I might elect to annuitize rather than withdraw to basis or take a policy loan. When we deal with cash value and supplemental retirement income, especially with life insurance, you want to have all these choices and the policy provisions. Remember, in my closing, current company practice is what is generally on the illustration, but I also want to look on the proposal about the contractual imperatives or the guarantees. Those guarantees tell me what could be the worst scenario, and I want to be able to give my client solace on those worst scenarios. That's the essentials.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance. and sponsored by Lincoln Benefit Life, an Allstate company.